Alaska Air Group is much more than just, a collection of planes flying from point A to point B. It's a complex holding company with diverse operations, constantly navigating a highly dynamic and, frankly, capital-intensive market. Our focus here is to seamlessly blend the quantitative data from their financials with the qualitative insights drawn from recent news and trading patterns. We want to peel back the layers, exploring the why behind the numbers and connecting the dots to recent events and the broader industry landscape you might already be tracking.
Okay, let's unpack this and start with the basics. Before we get into the financial nitty-gritty, let's establish a clear picture of who Alaska Air Group actually is. Where exactly do they fit into the bustling world of air travel?
Right. So, Alaska Air Group, Inc. It was initially founded way back in 1985, and it's currently headquartered up in Seattle, Washington. It functions as a holding company, primarily engaged in providing comprehensive air transportation services. And it's a substantial employer, too. You might be interested to know that it currently employs, 33,941 people. That underscores its significant operational scale and reach within the industry.
Wow, that's a lot of people.
It is. And the company strategically operates through three core segments. Each has a distinct focus that contributes to its overall business model and revenue generation. First, and certainly the most recognizable, is the Alaska Airlines segment. This is the primary component of the group, responsible for providing scheduled air transportation services for both passengers and cargo. Their fleet is primarily composed of modern Boeing and Airbus jet aircraft. They serve an extensive network of routes across the United States, including crucial Alaskan destinations, of course, as well as routes into Mexico and Costa Rica. This segment really forms the backbone of the company's operations.
Okay, the main airline most people know.
Exactly. Secondly, we have the Hawaiian Airlines segment. This part of the business also specializes in scheduled air transportation for passengers and cargo, leveraging its own fleet of Boeing and Airbus aircraft. What's particularly noteworthy here, and something popping up in recent news, is the Hawaiian integration.
Ah, right. I saw that mention.
Yeah, this isn't just a casual mention. It suggests a strategic and concerted effort to consolidate and optimize the operations of these two distinct carriers, Alaska Airlines and Hawaiian Airlines, under the broader Alaska Air Group umbrella. From an investor's perspective, this strategic integration could unlock significant synergies.
Synergies like cost savings.
Absolutely. Potential for optimized route networks, enhanced cost efficiencies by combining back-office functions, maintenance, that sort of thing, and maybe even an improved, more seamless passenger experience across both brands. It's a move that aims to build a more robust and efficient combined entity. Definitely one to watch.
Makes sense. And the third segment.
And then thirdly, there's the regional segment. This part of the business encompasses scheduled air transportation provided by Horizon Air, which is a wholly owned subsidiary of Alaska Air Group, along with other third-party regional carriers. These regional operations primarily utilize Embraer E-175 aircraft for passenger transport, focusing on shorter distance networks predominantly within the U.S. and Canada.
Okay, so smaller planes, shorter routes.
Right, and a key operational model for these regional flights involves what are known as capacity purchase agreements, or CPAs.
CPAs. Explain those quickly.
Sure. Under a CPA, a larger airline, in this case Alaska Airlines, pays the regional carrier a fixed fee to operate flights using the regional carrier's aircraft and crews. This arrangement significantly reduces the regional carrier's exposure to, volatile revenue fluctuations and unpredictable fuel price swings.
Ah, so it de-risks it for the smaller operator.
Exactly. And for the larger airline, like Alaska, it's a strategic way to expand its network and feed passengers into its main hubs without shouldering the full operational and financial burden of owning and operating those smaller regional jets. So it's a critical component that allows ALK to extend its reach and enhance its network strategy efficiently.
That paints a very clear and detailed picture of their operational structure and how their various parts fit together. So with these diverse segments, where does Alaska Air Group actually generate its revenue? What are the main streams that consistently fill their coffers?
Well, their revenues are predominantly derived from passenger tickets. That's the big one. This category isn't just the base fare, though. It also includes what's referred to as ticket breakage.
Ticket breakage, what's that?
That's essentially revenue from tickets that are purchased but then expire unused, which, surprisingly to some, can actually be a significant amount for airlines.
Huh, interesting.
Yeah, and it's important to note that these revenues are reported net of taxes and fees, meaning only the portion that directly benefits the airline is recognized as revenue. Beyond tickets, they also generate substantial revenue from passenger ancillary services.
Ah, the add-ons, checked bags, seat selection.
Exactly. Those increasingly common things passengers often opt for: checked baggage fees, preferred seats, in-flight Wi-Fi, other premium services. This has become a crucial revenue stream for pretty much all airlines now.
I bet.
And finally, their mileage plan loyalty program also contributes significantly. As members earn and redeem miles for flights and other benefits, this activity translates into deferred revenue for the company that's recognized over time as the services are provided. So this breakdown really illustrates ALK's strategy. It's a diversified airline group, strategically positioned across various routes and service models, effectively leveraging both its core flight services and a growing array of supplementary offerings to drive its top line.
Okay, makes sense. Now let's get into the nitty-gritty of their financial health, starting with those big picture numbers that give us an immediate sense of their overall size and how the market perceives them.
Absolutely. As of August 14th, ALK's last closing stock price was $56.87. That's the per share price, When we consider the company's overall size from a shareholder's perspective, its market capitalization stands at $6.56 billion.
Okay, $6.56 billion market cap.
Right. That's calculated by multiplying the stock price by the total number of outstanding shares. It represents the total value of all its shares currently in the market, giving you that immediate sense of how the market currently values the company's equity.
Got it.
However, for a more comprehensive and often more insightful measure when valuing a company, particularly one with significant debt like airlines, we turn to the enterprise value. For ALK, this is $10.78 billion.
Wow, almost double the market cap, $10.78 billion.
Exactly. The fact that their enterprise value is almost twice their market cap is a critical piece of information. Enterprise value goes beyond just market cap. It includes the market cap plus the company's total debt minus any cash and cash equivalents. This provides a truer, more holistic picture of the total theoretical cost to acquire the entire business, as it accounts for both the equity and debt components of its capital structure.
Right, includes the debt load.
Precisely. For an airline which almost invariably finances large, expensive aircraft purchases through substantial debt, enterprise value offers a much more accurate valuation perspective than market cap alone. It tells us that a significant portion of ALK's funding comes from debt, which is, yes, a common characteristic in this highly capital-intensive sector, but also a key factor for you to weigh when assessing its true value and financial leverage.
So that enterprise value really highlights the capital intensity of the airline industry. Let's move on to their top and bottom lines, their sales and their income. What do those numbers tell us about their operational scale and profitability?
Okay. For the trailing 12 months, or TTM, ALK reported sales, which is their total revenue, of $13.45 billion.
$13.45 billion in revenue. That's substantial.
It is. This impressive figure gives you a strong sense of the sheer scale of their operational activity, the enormous amount of money flowing into the company from all its various flight, cargo, and ancillary services over the last year. From that robust top line, they generated an income of $313 billion over the same period.
Okay, so $313 million in profit from over $13 billion in sales.
That's right. This income figure, often called net income or profit, represents the money left over after all expenses, operating costs, interest on debt, taxes have been paid. These two figures together are fundamental. They give you a clear sense of the magnitude of their operations and, crucially, of their ability to convert those billions in sales into actual profit for shareholders.
Got it. What about shares? How many are out there?
In terms of ownership structure and how the stock is distributed, the company has 115.28 million shares outstanding. This is the total number of shares issued and held by all shareholders, insiders, institutions, individuals like you, perhaps.
Okay.
A very slightly smaller number, 114.66 million, represents the shares in float. This is the portion of outstanding shares that are readily available for trading in the open market, excluding restricted shares, like those held by insiders or large long-term institutional holders.
So most shares are available for trading.
Pretty much. The fact that the shares outstanding and shares in float are so close for ALK suggests a relatively high degree of liquidity for the stock, meaning it can typically be traded without significant price disruption.
Now, here's where it gets really insightful, I think. We've seen the raw numbers, but how does the market actually value ALK in relation to those figures? And how efficiently do they operate? These ratios are often where the deeper story unfolds.
Absolutely. These ratios provide crucial context and allow for comparison. Let's start with valuation ratios, which help us understand how the market perceives ALK's worth relative to its earnings, sales, or assets. ALK's trailing 12-month price-to-earnings PE ratio is 23.12.
23.12. Okay, what does that tell us?
Well, this widely used metric tells us how much investors are currently willing to pay for each dollar of the company's earnings over the past year. Generally, a higher PE might suggest investors expect higher future growth, or that the stock is considered, a growth stock.
Right.
What's particularly striking, and frankly quite optimistic looking, is their forward PE, which is projected to be just 9.31.
Wow, that's a big drop from 23 down to 9.
It really is.
Yeah.
The significant drop from the TTM PE of 23.1 to the forward PE of 9.31 is a powerful signal. It strongly indicates that analysts and the market are expecting a substantial increase in future earnings, specifically over the next year.
So a big profit jump anticipated.
That's the expectation disk in, yes. This isn't just a minor improvement. It's a forecast for a robust rebound in profitability, suggesting that many of the headwinds ALK might have faced are expected to dissipate or even turn into tailwinds. This optimistic expectation is further reinforced by a PEG ratio of 1.15.
PEG ratio. Remind me.
Price earnings to growth. It's a more refined valuation metric because it measures the PE ratio relative to the company's expected earnings growth rate. A PEG ratio near 1.0, like ALK's 1.15, generally suggests the stock is fairly valued given its projected earnings growth. It implies investors aren't necessarily overpaying for its growth potential if those ambitious earnings growth targets materialize, of course.
That's a truly fascinating insight into market expectations for ALK's future. What about other valuation angles beyond earnings? How do they look when we compare the stock price to sales or assets, particularly for a capital-intensive airline?
Yeah, we certainly look at other ratios for a more rounded view. The price-to-sales PS ratio for ALK is 0.49.
Less than 1.
Right. This compares the company's market cap to its total revenue. For asset-heavy industries like airlines, which often have volatile earnings, PS can be more stable and offer a clearer valuation metric, less affected by temporary earnings dips or accounting choices. A low PS like this can sometimes indicate undervaluation compared to peers, or it might just reflect the inherent thin margins in the airline sector. Hard to say without comparison.
Okay, what else?
Then there's the price-to-book, PB ratio of 1.66. This compares the market value to its book value of equity, basically assets minus liabilities on the balance sheet. A PB over 1 suggests investors believe the company's assets are worth more than their accounting value, often due to things like brand, growth prospects, or efficient management. 1.66 seems reasonable for an established airline. Finally, the price-to-cash, PC ratio, is 3.05, comparing the stock price to its cash flow per share. This can be useful for companies with fluctuating earnings, as cash flow is, harder to manipulate than reported earnings and gives a sense of operational liquidity.
Good point.
Now, given that airlines are, as we keep saying, highly capital-intensive, constantly needing to invest in expensive aircraft, debt is always crucial. ALK has a debt-to-equity ratio of 1.62 and a long-term debt-to-equity ratio of 1.43.
Which sounds high, but maybe not for an airline.
Exactly. While these numbers might seem high in other sectors, they're not uncommon for airlines due to financing those big plane purchases. It's a structural characteristic, indicating heavy reliance on borrowed money. And the sources highlight recent news showing ALK's active debt management. For example, Natixis Corporate and Investment Banking provided a senior secured term loan for financing new Boeing 737 MAX 8 and 787-9 aircraft, maturing August 14, 2025. So they're actively investing in their fleet.
Modernizing.
Right. And there was also mention of the company looking to refinance pandemic loans back in July 2025. This suggests a proactive approach to optimizing its debt structure, maybe lowering interest costs as conditions improve or pandemic loans come due. That could free up cash.
Smart financial housekeeping.
Seems like it. Lastly, let's consider enterprise value multiples, which, as we discussed, are often preferred for comparing capital-intensive companies because they account for debt. ALK's EV/EBITDA is 7.28, and its EV sales is 0.80.
EV/EBITDA, earnings before interest, taxes, depreciation, amortization.
Correct. It gives a clearer picture of operating profitability before those big non-cash expenses and financing costs common in airlines. An EV/EBITDA of 7.28 is generally considered reasonable for an airline, suggesting a fair valuation relative to core operational cash flow. And EV sales, similar to PS but including debt, is 0.80. Both metrics reflect the market valuing ALK at less than 1 times its sales on an enterprise basis and at a reasonable multiple of its operational cash flow equivalent. It highlights their position in a sector where managing debt and investment is key.
This deep dive into the valuation and efficiency metrics really sheds light on how investors view ALK. Now, let's trace ALK's journey through its earnings and sales figures. Where have they been? And crucially, where are they projected to go? This growth trajectory is absolutely critical.
Right. Looking at earnings per share, or EPS, we certainly see a mixed but ultimately intriguing picture. The EPS for the trailing 12 months stands at $2.46. That's the profit allocated to each share over the past year. However, if we look at the EPS for this year, it showed a contraction of negative 32.05%.
Ouch, a drop this year. Why?
Could be various factors, lingering impacts from earlier challenges, maybe increased costs, specific one-off events. It indicates a tough patch recently on the profit front.
But the projections.
Despite this recent contraction, the projections for ALK are remarkably optimistic, suggesting a strong belief in a significant turnaround. EPS for next year is estimated at $6.11. That represents a substantial projected growth of 84.65%.
84% growth, that's huge.
It's a very robust forecast, indicating analysts expect a dramatic rebound in profitability. Looking even further, EPS for next quarter is forecast at $1.32, reinforcing that positive momentum is expected very soon. And over the next 5 years, the average annual EPS growth is projected at 20.11%. So sustained, strong earnings expansion expected, moving beyond just recovery.
Okay, so a rough recent past, but a very bright projected future for earnings.
That's the story the numbers tell. This strong future outlook follows a period of past EPS declines, specifically negative 6.55% over the last 3 years, and more pronounced, negative 13.04% over the last 5 years. These longer-term historical figures suggest significant challenges impacting per-share profitability over those periods: fuel costs, competition, and of course the pandemic.
Right, the pandemic hit hard.
Absolutely. Yet the TTM EPS year-over-year growth was 43.03%. That shows a strong recent rebound from a low base, even with a negative 17.05% EPS quarter-over-quarter change, which might reflect seasonality or short-term costs. And the CEO's comments echo this optimism. Ben Minicucci stated in July 2025 that the second half of the year will be way better than first half, and that Alaska Air reinstates profit forecasts as travel demand improves.
So management is confident.
Very much so. It implies strong belief in rising passenger volumes, better pricing power, and improved cost controls translating into much stronger earnings. It's a narrative of turnaround and significant anticipated profit expansion.
That's a clear trajectory for earnings challenging past, optimistic future. What about their sales growth, the top line? Is that showing strength?
Sales have shown much more consistent positive momentum, which is always a good foundation for future profitability. The sales year-over-year for the TTM was 27.81%.
Nearly 28% growth year-over-year. That's solid.
Very solid. And the sales quarter-over-quarter also saw strong growth at 27.86%. These robust recent figures clearly demonstrate healthy demand for their services and effective revenue generation. Looking back further, sales grew by 23.86% over the past 3 years and 5.97% over the past 5 years.
That 5-year number seems low compared to the others.
It does, but remember, that 5-year period heavily includes the pandemic years, which absolutely crushed travel demand.
Ah, right. Good context.
So the strong 3-year growth in the very recent TTM figures actually show a powerful recovery and expansion of the revenue base, signaling passengers are definitely returning to ALK. Now, the contrast between those past EPS declines and the consistently robust recent sales growth, coupled with those very optimistic future EPS projections, well, that implies an expectation of significant margin expansion or vastly improved cost controls.
Meaning they expect to keep more of that growing revenue as profit.
Exactly. It suggests that while the company has successfully grown its top line, getting more people flying, generating more revenue, it's now strategically poised to translate that revenue much more effectively into profitability. This shift could stem from various things: better fuel hedging, more efficient routes with fuller planes, more revenue from ancillary services per passenger, or those anticipated cost synergies from the Hawaiian Airlines integration.
Right, making the whole operation more profitable.
It strongly suggests that operational efficiencies and an improving pricing environment are expected to fully kick in, leading to a much healthier bottom line. This is a key part of ALK's story right now, the transition from just recovering revenue to generating robust, sustained profits.
So we've seen the impressive sales growth, but the real test for an airline like ALK is how much of that revenue actually makes it to the bottom line. Let's talk about their margins. How efficient is ALK at turning revenue into profit?
That's a crucial question, because margins tell us how well a company manages costs at various stages. Let's break it down. The gross margin stands at 16.24%. This is profit left after deducting direct costs of service, primarily fuel, flight crew salaries, immediate maintenance.
16 cents on the dollar before other costs.
Roughly, yes. It indicates that for every dollar of revenue, about 16.24 cents are left to cover everything else and eventually become profit. Moving further down, after considering general operating expenses, we get the operating margin, which is 5.64%.
Big drop there, from 16% down to 5.6%.
It is. This reflects profitability from core operations after covering administrative costs, sales, marketing, other indirect costs, but before interest and taxes. That drop highlights the substantial impact of broader operational overheads in this industry. Finally, the profit margin is 2.33%.
Wow, just over 2 cents profit for every dollar of sales.
Exactly. This is the ultimate bottom line profitability, showing the percentage of revenue that translates into net income after all expenses, including interest on debt and corporate taxes, are accounted for. These margins, especially the narrow profit margin, are important indicators of cost management and starkly illustrate the inherent challenge of achieving robust profitability in the airline industry due to high fixed costs and intense competition. Airline profit margins are notoriously tight.
Those profit margins do seem quite tight, which, as you pointed out, is very common for airlines. How about liquidity? Can they cover their short-term obligations? Does that low profit margin reflect cash flow issues?
For liquidity, we look at ratios assessing their ability to meet short-term liabilities. The quick ratio is 0.49, and the current ratio is 0.52.
Both below 1.0, which usually raises eyebrows.
It does in many industries. These figures are indeed relatively low compared to sectors where ratios closer to 1.0 or higher are preferred. However, and this is crucial, it's not uncommon for airlines. In fact, it's a typical characteristic of their business model.
Why is that?
Well, airlines have a unique structure. Their primary assets are tied up in long-term investments, like aircraft, very expensive, not easily converted to cash. More importantly, they collect revenue from tickets in advance for future flights. This advance payment shows up on their balance sheet as a liability, unearned revenue, because the service hasn't happened yet.
Ah, so they have the cash, but it counts as a liability until the flight.
Precisely. It's not recognized as current cash or earnings until the flight occurs. So while these low ratios might look concerning elsewhere, for airlines, it's a standard operational aspect reflecting their unique cash flow cycle and asset structure. It doesn't necessarily signal immediate financial distress.
Okay, that makes sense in context.
Shifting focus now to how effectively ALK uses its assets and capital to generate returns, we have several important metrics. The return on assets, ROA, is 1.78%.
Very low.
It is. This measures how efficiently the company uses its total assets to generate earnings. A low ROA is also typical for capital-intensive industries like airlines, where a massive asset-based plane's infrastructure is needed to generate relatively smaller profits. Then there's the return on equity, ROE, which is 7.66%.
Better, but still not huge.
Right. This indicates how much profit the company generates for each dollar of shareholders' equity. It's a key measure from the equity investor's perspective, showing how effectively management uses shareholder money. Lastly, the return on invested capital, ROIC, is 3.26%. This is a more comprehensive measure, showing the return on all capital invested, both debt and equity.
Also quite low.
It is. ROIC evaluates the efficiency of capital allocation regardless of financing. These three metrics together paint a picture of how effectively ALK deploys capital, highlighting the ongoing challenge of generating high returns in this tough industry. For an airline, these ROA and ROIC figures are generally in line with industry norms, suggesting they operate efficiently within their sector's constraints.
So despite those tight margins and the unique liquidity situation, it seems ALK is deploying its capital in a manner consistent with industry challenges. Let's shift gears now and look at how ALK's stock itself has performed. What does the market activity tell us about investor sentiment?
Okay, stock performance. In the short term, ALK has certainly shown strong positive momentum, painting a picture of recent investor confidence and that recovery narrative we talked about. Over the past week, the stock gained 6.80%. Over the past month, an even more significant 10.11% increase. And for the past quarter, it was up 5.00%.
Strong recent gains then.
Definitely. This recent surge aligns perfectly with several positive headlines from around August 12, 2025. We saw reports like airline stocks take flight, rising above cloudy early-year outlooks, suggesting a broader industry recovery. Another noted U.S. airline shares jump as airfare data signals improving pricing power, pointing to airlines' ability to charge more key for profits.
Yeah, pricing power is crucial.
And further reinforcing this, cheaper gas, pricier flights. Airline stocks rally on July inflation report, indicating favorable fuel costs, a major expense coupled with inflation allowing higher prices, are boosting the sector.
So a confluence of positive factors recently.
Seems that way.
That's a clear picture for the short term. But what about the longer view? Does this recent rally reflect a sustained trend, or is it just a bounce back from deeper issues?
You've hit on a crucial point. Longer term, the picture is indeed more mixed, suggesting significant volatility and challenges over the years. While the stock delivered impressive returns over the past year, 64.41%, 3 years, 24.36%, and 5 years, 55.34%, indicating a very strong recovery from pandemic lows and subsequent growth.
Those are good numbers.
They are, but it has also been down over the past half year, negative 22.92%, and year-to-date, negative 12.17%.
So a pullback more recently before this latest surge.
Exactly. This stark contrast suggests the recent gains are largely a recovery from a more challenging period earlier this year, where the stock faced headwinds causing a notable pullback. And historically, looking back 10 years, the stock is actually down modest 26.86%.
Down over a decade. Wow.
Yeah. It indicates that despite the impressive recent and medium-term performance, ALK's stock has struggled to maintain or increase its value over a full decade. This might raise questions about long-term consistency versus the broader market and really signals that highly cyclical nature inherent to airlines.
Makes sense. Volatile industry, volatile stock.
Very much so. The stock has also seen significant price swings over the past year, reflecting this. It reached a 52-week high of $78.88. Its current price of $56.87 is about 27% below that high, so it pulled back considerably. However, it's also a substantial 65% above its 52-week low of $34.44.
That's a huge range, $34 to $78 in a year.
It points to significant price volatility. Good for traders maybe, but higher risk for long-term stability seekers.
So significant swings are definitely part of ALK's story. What about its movement compared to the broader market? Does it swing more wildly than, say, the S&P 500?
That's precisely where beta comes in. ALK exhibits a beta of 1.44.
1.4
Meaning it's more volatile than the overall market. If the market moves up or down by 1%, ALK's stock, on average, tends to move by 1.44% in the same direction. So it carries higher systemic risk and can experience larger price swings, both up and down, amplifying market movements.
Okay, more volatile than average.
Correct. Further examining its short-term price movements, its daily volatility is 4.34% and monthly volatility is 3.77%. These quantify the average percentage change, again confirming its relative dynamism. The average true range, ATR, is 2.12. ATR measures volatility by looking at the average trading range each day. An ATR of 2.1 suggests the stock's typical daily high-to-low range is about $2.12, useful for understanding typical fluctuations.
And RSI.
The Relative Strength Index, RSI, is 61.23. RSI is a momentum oscillator, 0 to 100. Above 70 is often seen as overbought, below 30 oversold. 61.23 suggests the stock is currently neither overbought nor oversold healthy momentum without being unsustainably stretched.
Okay. What about short interest, people betting against it?
Finally, we see a short float of 5.32% and a short ratio of 2.23. The short float is the percentage of available shares sold short by investors betting the price will fall. 5.32% suggests moderate bearish sentiment, not excessively high, especially for a volatile stock.
And the short ratio.
Also called days to cover. It tells us how many days it would theoretically take for short sellers to buy back all the shares they borrowed, assuming average daily volume. A ratio of 2.23 suggests just over 2 days. It indicates the intensity of bearish sentiment. 2.23 is relatively manageable, not indicating extreme conviction among shorts or difficulty covering. Overall, stock performance paints a picture of a company navigating a strong recent recovery within a historically volatile, cyclical industry amplified by its higher beta.
So after dissecting all those numbers and market behaviors, what do the professionals on Wall Street actually think about ALK's prospects? What's the overall consensus from the analyst community?
Right, the analyst view, the consensus analyst recommendation, often called RECOM for ALK, is 1.44.
1.44 on what scale?
It's typically on a scale where 1.000 is strong buy, 2.00 is buy, 3.00 is hold, and so on. So a 1.4 falls firmly in the buy territory, actually leaning quite strongly towards a strong buy recommendation.
So Wall Street is generally positive, leaning towards very positive.
That's the consensus, yes.
Yep.
It suggests a broadly positive outlook, indicating they largely believe the stock is likely to outperform or offer a good opportunity, especially given that anticipated earnings return we discussed.
And do they have a price target?
They do. Analysts collectively have a target price of $65.15 for the stock. This is higher than the current price of $56.87, suggesting an expected upside of roughly 14.5% from its current level if their collective forecast holds true.
So they see room for it to run higher.
That's the implication. It reinforces their positive stance.
That's a strong vote of confidence overall. But what about the recent analyst activity? You mentioned that things have been dynamic. Are firms changing their tune?
Indeed, the activity has been quite dynamic over the past year, reflecting that evolving landscape for ALK and the airlines. We've seen a clear trend of increasing confidence in upgrades earlier in the period as the industry recovered. While some firms, like UBS, maintained a cautious neutral, even resuming coverage with that rating after a prior downgrade. Others, notably TD Cowen, have consistently reiterated buy ratings. Although even TD Cowen adjusted its price targets quite a bit at one point, raising it significantly, then pulling back.
So even the bulls are adjusting targets.
Right. This constant adjustment highlights how analysts are recalibrating based on new conditions, earnings, company news. Overall, though, there's been a notable wave of upgrades. Susquehanna went neutral to positive, Melius from hold to buy, Barclays initiated overweight, Wolfe Research and Deutsche Bank also upgraded.
Lots of upgrades, then.
Generally, yes, signaling increasing confidence in ALK's recovery and performance. However, it's equally important to acknowledge the occasional downgrades, like Raymond James moving from strong buy to market perform, and Melius earlier downgrading from buy to hold. These shifts often reflect concerns about valuation at certain points, competition, or specific risks that might temper the outlook short term.
So a mix, but generally positive leaning.
Exactly. This dynamic landscape underscores that analyst consensus, while valuable, is one piece of the puzzle, not definitive advice. It's a continuous process of integrating new information.
Okay, so we've covered the external Wall Street view. But what about the people inside the company, or even in Congress? What does their trading activity tell us? This behind-the-scenes stuff can sometimes offer unique insights.
Right, let's look at insider activity first. Insiders meaning executives, directors, significant shareholders collectively own 0.56% of ALK shares.
Not a huge percentage.
No, but still means their interests are tied to performance. Over a recent period, however, there have been net insider transactions, reflecting a netically 7.43% change.
Negative 7%, meaning more selling than buying.
That's right. It implies net selling by insiders over that time. The aggregate value of shares sold exceeded the value purchased.
And who was selling?
When we dive into specifics, we see a consistent pattern of sales by key executives. Shane Tackett, the CFO, engaged in multiple sales, often after exercising stock options. Andrew Harrison, the CCO, also had significant sales, frequently following option exercises. Other executives like Emily Halverson, VP Finance, Constance von Muehlen, COO, and even CEO Ben Minicucci have reported sales.
So the top brass is selling. Is that a bad sign?
It's important for you to understand that while these are sales and net selling might seem negative, many are directly tied to option exercises. Stock options are common executive compensation. When they exercise options, they convert compensation into shares, often at a lower price. Selling these shares after exercise can be for many legitimate reasons: personal financial planning, diversifying portfolios, covering taxes from the exercise, funding major life events.
So not necessarily a lack of confidence in the company.
Not always, no. It doesn't automatically signal that. However, the consistent pattern of net selling, even when tied to options, is a data point for you to observe and consider. It reflects compensation being realized as cash, a natural part of executive pay.
Okay, a crucial distinction. What about our elected officials in Congress? Do they trade ALK?
Yes, some members of Congress have reported trades in ALK, for instance. Lisa C. McClain, Republican from the House, had a purchase and a sale in June 2025, both small, in the $1,001 to $15,000 range. Ro Khanna, Democrat from the House, has shown a pattern of both buys and sells over several years, generally in that same small range, with recent sales in November 2024. Earl Blumenauer, Democrat from the House, also reported small buys and sells. Notably, Victoria Spartz, Republican from the House, executed a larger sale, somewhere between $250,000 and $500,000, but that was back on May 17, 2021.
So mostly small trades, except for that one larger sale a while ago.
Pretty much. These congressional trades, while reported, are typically tiny relative to ALK's multi-billion-dollar market cap and daily trading volume. They don't necessarily reflect deep insight into the company's health, nor do they carry the same weight as big institutional moves or direct insider activity from executives.
So Probably not a major indicator for investors.
Generally not, compared to other data points. We're just reporting the facts from the source material, giving you the complete picture of who's trading without endorsing any viewpoint on their significance or implying special knowledge. It's public disclosure.
Got it. Beyond market trading, how does ALK engage with the government? Lobbying, contracts? What financial impact does that have? That's another layer for a regulated industry.
Right. Alaska Air Group is quite active in corporate lobbying, spending money to influence legislation and regulations. Their estimated quarterly lobbying spending has been significant and notably shows a clear upward trend. For example, it reached $540,000 in July 2025, $500,000 in April 2025, and $450,000 in January 2025.
Over $500,000 a quarter recently? How does that compare to the past?
It shows a considerable increase from earlier years. For instance, their quarterly spend was around $200,000 back in late 2014.
So they've more than doubled their lobbying spend. Why?
This consistent and increasing investment indicates a growing commitment to influencing policy. It likely reflects a more complex regulatory environment, new industry challenges, or specific strategic interests like the Hawaiian integration, maybe. It underscores how important government relations are for a major airline.
What issues are they lobbying on? Just airline stuff?
Well, aviation, airline, airports is consistently there, of course. That covers flight operations, safety, routes, airports, their core business. But they also lobby on issues that might seem less direct, but are critical. Things like education, maybe workforce development, taxation, internal revenue code, favorable tax policies are huge, banking for financing planes and debt. Even agriculture may be related to biofuels or land use.
Interesting. What else?
They lobby heavily on fuel gas oil issues. Fuel is a massive cost, so influencing energy policy or pricing is vital. Homeland security is key, given air travel security requirements impacting operations. And finally, budget appropriations, as federal spending affects airports, air traffic control, the whole ecosystem.
So a very broad range of policy interests.
Absolutely. For an airline, these diverse efforts are crucial. They cover regulations, costs, taxes, security, all directly impacting operations, competition, and profitability. It's a comprehensive approach to managing their external environment.
That's extensive lobbying. What about direct government contracts? Do they get revenue directly from federal agencies?
Yes, ALK also receives federal grants, loans, and direct purchases. While these amounts are relatively small compared to their total multi-billion-dollar sales, they are additional revenue streams. For example, they've secured contracts with the Department of Defense, DoD, like $149,310 in July 2022, and a larger $326,220 in August 2021, often transporting personnel or cargo for the military.
Okay, DoD contracts. Anywhere else?
Smaller contracts with other agencies, too. The Department of Agriculture, like $18,540 in July 2024, maybe transport related to that, and contracts with the Department of the Interior. These interactions, both lobbying and contracts, highlight their proactive approach to influencing policy and securing business in a highly regulated, often government-dependent industry. It can provide a competitive edge and some stability.
Okay. So we've dissected ALK's financials, its market performance, political engagements. Now let's tie it all together. What does this all mean when we connect the numbers to the latest headlines? Let's sift through the recent news, the good and the bad.
Right, connecting the dots. On the positive side, ALK has shown strong financial performance recently, directly impacting those valuation metrics we discussed. They reported robust Q2 2025 earnings, beating estimates and hitting record revenue. That's a significant indicator of operational success and strong demand, feeding into those optimistic forward earnings projections.
The market likes seeing those beats.
Definitely. And the CEO, Ben Menikuchi, has been explicitly optimistic, stating the second half of the year will be way better than first half. Plus, the company reinstated its profit forecast as travel demand improves. This suggests strong management confidence and continued recovery and profitability. They seem to feel they're past the worst.
And this aligns with broader industry news?
Yes, it aligns with headlines like airline stocks take flight, improving pricing power, and the boost from cheaper gas, pricier flights. A favorable macro environment seems to be helping ALK specifically.
What about strategic moves?
ALK is also actively pursuing growth and operational enhancements. Big international expansion, new flights to London, Reykjavik, Rome from Seattle, plus new routes connecting California and the Pacific Northwest.
Moving beyond just domestic.
Clearly. It's a strategic move to capture more market share, diversify revenue, maybe tap into higher margin international travel. The Hawaiian Airlines integration is noted to be gaining cargo momentum, suggesting synergies are starting to materialize there. Financially, they secured that senior secured term loan for new Boeing aircraft, 737 MAX 8s and 787 9s, showing continued fleet investment essential for long-term growth.
Keeping the fleet modern.
And they're proactively working to refinance pandemic loans, optimizing their balance sheet, and potentially reducing borrowing costs. They've even focused on the passenger experience, improving in-flight dining, small detail, but affects loyalty.
So, a lot of very positive momentum and strategic initiatives underway, but no company, especially an airline, operates without challenges. What negative headlines or operational issues have emerged that ALK is navigating?
You're absolutely right. The airline industry is prone to shocks and complexities. ALK is no exception. One significant recent challenge was the IT outages in July 2025, which temporarily grounded Alaska Airlines' entire fleet.
Oof, that sounds bad.
It was. While operations resumed relatively quickly, it highlights a critical vulnerability in their tech infrastructure, the potential for widespread disruption, significant financial costs from cancellations, and immediate customer frustration.
Definitely a risk factor. What else?
Separately, there's ongoing scrutiny related to Boeing aircraft, which are a big part of ALK's fleet. Recent news includes flight attendants suing Boeing over the Alaska Airlines door plug blowout back in August 2025, and the NTSB pressuring Boeing regarding the 737 MX-9 incident.
Right, those Boeing issues linger.
They do. And while primarily directed at Boeing, these issues create operational and reputational risks for Alaska Air as they operate these planes and rely on Boeing for expansion. Passenger confidence and operational reliability can be impacted.
Makes sense. Any other headwinds?
Cybersecurity has also been a concern. Hawaiian Airlines had a cybersecurity event in late June 2025, and ALK Group itself reported an incident at a subsidiary in early July 2025. These underscore the increasing digital risks for airlines holding sensitive data and relying on critical systems. They're prime targets.
True. Competition.
Intense. There's specific mention of Delta and Alaska Air squaring off in battle for Seattle, indicating fierce competition in a key market, which can pressure pricing and market share. And despite the overall optimism, the CEO himself acknowledged pricing struggles, even while anticipating a full-year profit. This suggests that while demand is up, raising prices aggressively isn't easy due to competition.
So pricing power isn't guaranteed.
Seems odd entirely. Lastly, the company settled a significant $1 billion lawsuit in July 2025.
$1 billion. That's huge.
It is. While settling avoids prolonged legal battles, such a large sum is a substantial financial event and a big cash outflow impacting their health and balance sheet short term.
Okay, so a mix of good news and real challenges.
What we see here, then, is a company undeniably proactive in growing and optimizing international expansion, Hawaiian integration. But it's simultaneously navigating inherent industry complexities and unexpected challenges. IT hiccups, supplier issues with Boeing, cyber threats, intense competition. These events directly influence the financial metrics impacting revenue, costs, investor confidence, stock volatility. It's a complex balancing act between seizing growth opportunities and mitigating significant risks. All of this will shape its long-term trajectory.
What a journey. From its core operations and nuanced financial metrics to the swirling news events and market dynamics, we've truly taken a deep dive into Alaska Air Group.
We have. We've seen a company with ambitious growth plans and a clear path to recovering profitability, reflected in those optimistic forward earnings projections and recent positive stock performance. Yet, it operates in that highly dynamic, challenging environment, facing operational hurdles like IT disruptions, supplier issues, cyber threats, alongside external pressures. The pattern of insider selling, likely often compensation-related versus optimistic analyst ratings and recent market momentum, paints that complex picture. Different perspectives exist even within a clear recovery. Their active debt management and expansion plans signal a forward-looking strategy, but also come with inherent execution and market risks that need careful balancing.